Welcome to our first webinar on the SEC's new marketing rule for investment advisors that was published almost exactly 2 weeks ago today. So on today's webinar, we plan to provide you with a description of the new rule and its various provisions. And we'll briefly talk about related amendments to Form ADV, and then we'll highlight some of the new record requirements that are going to kick in. So our focus today will be to tell you about, really our focus today will be to introduce you to the new marketing rule, tell you about what's changed from the current rule, as well as from the proposals that were published back in 2019. And then we'll wrap it up by hopefully talking about the implementation period and provide you with some, what we think are practical takeaways for you to consider as you begin the process of implementing the new requirements during the roughly 18-month transition period. Now, there is a lot for us to talk about regarding the new rule, and I can tell you there's really no way, I think, for us to be able to explain every detail in the 60 minutes that we have together. So that's why we're planning a series of webinars, and on our future webinars, including one that we have scheduled for January 21st of this month, we'll do deeper dives into the various provisions of the marketing rule. More information about those webinars will be provided shortly. So before we get started, just a few housekeeping matters. As I said, we scheduled this webinar for 60 minutes. If we run over a couple of minutes, that's fine. We do have a lot of ground to cover, but we'll try our best to answer your questions, which you can type into your chat box. Now, if for some reason we don't get to your questions, please reach out to us after the webinar, and we'll be happy to talk with you. You could change the slide there. So okay, so the background here. Is fairly straightforward. Actually, I'm sorry, you can go back. Actually, this is good. We're good. Okay. So the background here is fairly straightforward. So when effective, the new marketing rule will completely replace the current advertising rule, which was adopted in 1961, as well as the cash solicitation rule that was adopted in 1979. Now, these rules have not been materially amended, and obviously, a lot has changed in the decades since their adoption. And what's resulted, and I think what everyone on this webinar is painfully aware of, is a regulatory patchwork of SEC no action letters and staff guidance that have been issued over the years, really all in an effort by the SEC staff to adapt with the changes that have taken place in the marketplace, particularly in how folks communicate with each other. And so that's why we were extremely pleased when the SEC announced several years ago that they plan to modernize these rules, particularly the advertising rule. The advertising rule is something that the IAA in particular has been asking for the SEC to change, to modernize, to update for nearly 20 years now. So, I can tell you we feel like here at the IAA that this is a huge win for our advocacy. Now, in terms of the procedural posture, the SEC proposed new rules, amendments to the cash solicitation rule as well as the advertising rule, at the end of 2019. They received over 90 comment letters, including I think a 79+ page letter from the IAA, which, by the way, is cited over 100 times in the final adopting release. And the staff and the commissioners have really spent the last year, all of 2020, developing this new rule, engaging in industry outreach, including numerous discussions that they've had with us at the IAA, where we've been able to provide them with more feedback, answer their questions, and really help, I think, hopefully, be of assistance to them as they develop the new rule. And I think when you look at the final output, again, I think we're extremely pleased as to where we landed, and we felt that all that time was well spent. Now, there's a lot to digest here. The adopting release is over 400 pages. There are a lot of nuances. There's some new concepts. There's a lot of interplay that's involved here. But I can tell you, on balance, the new rule, as adopted, is a huge improvement over the current framework, as well as what was proposed back in 2019, both from a compliance standpoint, but also from a business marketing point of view. And as I said, it's largely consistent with our advocacy over the years, including moving away from the patchwork regulation that I talked about, the SEC no action letters and staff guidance, to a rule where the staff hopefully does not have to provide additional guidance, but a rule that's evergreen and that can adapt with changing circumstances, technology as they're sure to develop. And so hopefully this is a rule that can sort of change with the times. Now, a big component of the rule, is that it's principles-based. Again, this is something else that the IAA has really been pushing for, so we were happy to see that. The rule no longer has the per se prohibitions that you see in the current advertising rules. So from this day forth, or when the effective date kicks in, you'll have some disclosure requirements, some provisions built into the rule. But on balance, we think this is a huge improvement over the current framework. The new rule will permit third-party ratings, again, with certain conditions, just primarily disclosure related. Now, the new rule doesn't directly address social media. It's not in the rule text anywhere, but the way the rule is set up, the framework, particularly the guidance that was provided in the adopting release, really addresses social media to a great extent. And we're hopeful that the new framework will allow you to start engaging in that platform in a way that can sort of help you grow your business, communicate with your clients. And we'll talk a little bit about that later today. Now, for the first time, the new rule will also provide a sensible framework for performance advertising. And perhaps I think what is probably the biggest win in terms of changes from the proposal is that there will be no new procedural requirement to pre-review all advertisements. As I said, this is a huge win. And again, this is consistent with our recommendation. And I say this is a big win because, as we noted in our comment letter, the proposed pre-review requirement would have imposed enormous compliance burdens and perhaps more importantly, interfered with your communications with your existing clients. So we were extremely pleased to see none of that made it into the rule text. Now, the commission did note, right, and again, this is something we pointed out in our comment letter, that there is a compliance program rule that requires firms to have policies and procedures in place regarding marketing. They talk about that. Laura will touch on that a little bit, but again, nothing new is required with respect to the procedure. So that, again, that's a positive development. So Megan, if we could turn to the next slide, please. So the current advertising rule 2064-1 has been completely rewritten to address advertising and solicitation activities. They've essentially merged the two prior rules together and created a completely new rule. Now, as you can see from this slide, the structure of the rule is essentially, hold on, I just lost my second. The structure of the rule is these various provisions. You have the general prohibitions, which we'll talk about today. There are sections, there's a section in there that talks about testimonials and endorsements. There's a section devoted to third-party ratings, a detailed section devoted to performance advertising. At the end, you have a definition of some of the various terms that are used throughout the rule text, including the definition of advertising, which I would like to turn to next, Megan. So as you can see from this slide, the amended definition of advertisement contains two prongs. One that captures communications that are traditionally covered by the advertising rule, and another that governs solicitation activities that were previously governed by the cash solicitation rule. Megan, if you could turn to the next slide, please. Okay, so on this slide talks about prong one of the new definition of advertising, which covers communications other than compensated testimonials and endorsements. So as you can see from the slide, an advertisement is any direct or indirect communication to more than one person or to one or more persons if the communication includes hypothetical performance. A couple of key points here. We've highlighted some of the key words in red for you. So the words direct and indirect, what are they trying to get at there? So here, the notion here is that advertisements that are prepared for or on behalf of an advisor that are being sent out by intermediaries and consultants and other advisors. So for example, in a fund-of-fund structure or a feeder structure. Now, Mike will touch on this a lot later on in this presentation, but really the key here is that the advisor must actually participate or take some sort of affirmative step to develop the advertisement. Now, the commission notes in the adopting release that this is a facts and circumstances issue, but I can tell you just based on my initial reading anyways, I think there will be a lot of interpretive questions that come up here, which Mike will touch on. One key point here, the commission had proposed language that had indicated, instead of these words, they had used by or on behalf of. As we noted in our comment letter, there are a lot of concerns were raised regarding an advisor that would potentially have been responsible for third-party communications that they really had no involvement in. So we were extremely pleased to see them move away from that and kind of go back to this direct and indirect language. The language more than one person. This one, perhaps is probably the biggest improvement over what was proposed. Under the proposal, this language would have been one or more persons, which essentially would have brought all one-on-one communications into potential scope of the advertising rule. This more than one person should sound familiar to you because it's in the current rule. Essentially, it acts as an exclusion for one-on-one communications, except with respect to communications where that include hypothetical performance, which the SEC retained the sort of one or more as proposed aspect of it. This is really not a surprise. Hypothetical performance is an area that the commission and the staff has really focused on a lot over the years, hence some of the provisions that we'll talk about later. So that is now included within the definition of advertising. Now, the other two sections, the communications would have to offer investment advisory services with regard to securities. Now that language is important because it really kind of scales back the scope of the advertising rule to really talk about advertising services with regard to securities. The proposals had potentially broadened the scope to kind of go beyond advertising scope. Advisory services, and we talked a lot about that in our comment letter. So we were pleased to see them sort of scale that back a little. And for the first time, it would also involve prospective clients, and private fund investors, which is completely new. It was in the proposal, but just a couple of points here. Private fund investors does not include registered investment companies or BDCs, and the proposals had it termed as pooled investment vehicles. They've changed it, and now it's limited to 3C1 and 3C7 funds. And the second prong here is, the second subparagraph here is that is really to deal with situations with respect to offering new advisory services to existing clients. A couple of points here which I think are important. As I noted, this is designed to talk about marketing new advisory services to existing clients. They did not go with the language that they had proposed, which would have been or retain. There were a lot of concerns with that language that we raised, including that it could potentially blur the line between client servicing and marketing. And so we were extremely pleased to see them kind of go back to this language and really limit the scope in this regard. Megan, if you could change the slide, please. Great. So with respect to prong one, it does include certain exclusions that are built into the rule text. So the communications that are live, oral, those will not be subject to the new rule. The couple of points here that I want to make. The rationale with respect to this exclusion is that they recognize that under certain circumstances, if you're speaking at a live event or you're being interviewed by the press, and a speaker is not talking based on any sort of prepared remarks, they don't have a time to really sort of think and edit their remarks, right? They're just speaking live in an oral communications. Those would be excluded from the definition. But in situations where the speaker is speaking from a script or prepared remarks, those would be deemed subject to potential advertising within the scope. Information that's required in notice or other filings such as your Form ADV or CRS, as well as non-SEC regulated filings or disclosures would also be outside the scope of potentially outside the scope as being advertised, and as long as they're sort of reasonably designed to sort of satisfy those obligations. Communications that include hypothetical performance would be excluded, but only if they're in response to unsolicited requests for such information or to a prospective or current investor in a private fund advised by the advisor in a one-on-one communication. So they included hypothetical in one-on-one situations. They've scaled it back as long as you're responding to an unsolicited request or an investor in a private fund in a one-on-one communication. Just by mere fact that it has hypothetical performance does not bring it within scope. So at this point, I'd like to turn it over to Laura to talk about the next prong.
Thanks, slide 10. So the way that the marketing rule captures traditional solicitation activities is with the second prong of the definition of advertisement. This part of the definition applies to a compensated testimonial or endorsement. It applies whether or not the communication is made orally or in writing. It applies whether or not the communication is made to just one person or to more than one person. And it applies whether or not the compensation is cash or non-cash. What's non-cash? Some examples that the commission provided in the release are directed brokerage, awards or other prizes, and reduced advisory fees. By contrast, if you're dealing with an uncompensated testimonial endorsement, you would want to look to the first prong of the definition of advertisement to figure out whether it falls within the definition. Next slide. So as Sanjay alluded to, despite the objections made by the IAA and many others, the rule has been expanded to cover not just marketing to clients and prospective clients, but also marketing to investors and prospective investors in private funds that an advisor manages. Private fund meaning a 3C1 or 3C7 fund only. The rule does cover securities offerings and private funds to prospects, as well as offers of new investment advisory services to current clients or current private fund investors. In contrast to private funds, registered investment companies and business development companies were spared from the new rule. Sanjay?
Next slide, please, Megan. So just to sort of recap before we turn it over to go into a little bit more detail on the definition. So the definition of advertisement is media neutral. So the new formulation will cover all communications, regardless of how they're disseminated, subject to certain exceptions, but that now will include social media and all sorts of other platforms, like for example, on the internet. It will include communications distributed by the advisor itself, as I noted, or through intermediaries, affiliates, and third parties, and Mike will sort of go into that. The focus of the new definition is really on the goal of the communication and generally excludes day-to-day communications to existing clients with a few exceptions that we'll talk about. Importantly, it retains the more than one exclusion for one-on-one communication subject to certain exceptions. And it expressly, as Laura just noted, covers communications directed to existing as well as prospective investors in private funds advised by the advisor. So let me now turn it over to Mike to sort of walk us through what's included and what's not included as an advertisement. Mike.
Thanks, Sanjay. So
next slide, please. Thanks.
There's a lot here in this definition, and what we wanted to do was answer some of the questions that we thought would be most common or most salient as to certain types of material. And actually, I'm somewhat encouraged as I look to the webinar chat that some of the issues here that we're going to address are already coming through as questions. So the first thing that we want to address is the interpretation of this concept that a communication needs to go to more than one person. First, we should address the carve out for hypothetical information. This is going to be somewhat confusing. It's going to be tough to control, but the fact of the matter is, if your communication contains hypothetical information, which, as we will talk about more later, includes target performance, which is going to be a problem. If it includes hypothetical information, your communication is almost certainly going to be an advertisement, unless it is made in a one-on-one communication with a private fund investor or a prospective private fund investor, or you are providing it in response to a specific unsolicited request from a prospective advisory client. Save for those exceptions, all hypothetical information, hypothetical performance information will be considered an advertisement, even if you provide it in a one-on-one scenario to a prospective advisory client. This also includes what we call bulk emails or bulk communications, where if you have one set of content and the content is personalized in an email, for example, through the address to whom it is addressed, if you personalize it by identifying the name of the recipient, maybe even some more sophisticated personalization. Now, under those circumstances, bulk emails and the templates that are used to create them would be considered advertisements. Although we don't have it on the page here, another important interpretation here, similar to templates and bulk emails, is that when a communication is designed for multiple recipients, it is designed as a promotional material for multiple recipients, but it is only delivered in one-on-one sit-downs, that communication is also going to be an advertisement, and that was addressed in the interpretations that were included with the adopting release. So there could be situations where you feel that the best way to answer an unsolicited request is by the delivery of a fact card, but if you develop that fact card with the intent to deliver it to many people, it's going to be an advertisement. But now for some good news, what does this exclude? Traditional correspondence with no hypothetical performance information, not an advertisement, not subject to the requirements of the rule. It's still subject to the anti-fraud provisions of the Act. You can't defraud someone in a standard communication and then say, well, it's not an advertisement, so I'm clear. But it's not subject to the specific requirements that we'll get into momentarily. Responses to unsolicited requests, and consistent with the position that the staff has historically taken, if you send an email or you send a communication to a dozen people, all of whom work for a single entity, and that entity is a single opportunity, that is considered a communication with one person and is outside the scope of the definition. Next slide, please. So now we'll think about what it means for an advertisement to be offering new investment advisory services to current clients and investors. Some of you may recall in the rule as proposed, the definition of an advertisement would include communications to retain existing clients and investors, and there's really no way to know or to determine with any confidence whether a communication with an existing investor was designed to retain that investment. This change and the additional information that was provided in the adopting release in the form of guidance is very, very helpful. So what's included? A cross sale, a traditional cross sale to an existing client, that's considered an advertisement. Likewise, a communication that expressly seeks to expand an advisory relationship, right? That if you're an institution, suggests that you would like to expand the size of a mandate, or if you're a wealth manager, suggests that it would be prudent for your client to bring the half of their assets that are with someone else over into your shop. Even though it's not necessarily a cross sale, that would be an advertisement because it's seeking additional services. On the other hand, account statements that pertain to the services presently provided, whether to fund investors or to advisory clients, are excluded. This could include cash flows, transaction reports, performance of the account. All of those things would be excluded. Likewise, correspondence with the client regarding the current services provided to the client would also be excluded. And look, we're pretty confident that if a client sends you an email or calls you up on the phone and says, I would like to understand why performance has been poor, or I would like to understand why it would make sense for me to stay with you and stay with this strategy when it has been suggested to me that a different strategy would be better. Those are communications designed to retain the client. They are also answers to the client, and they pertain to the questions asked by the client. Those are not communications that are designed to solicit additional services and generally would not be advertisements. This is a very important change from the rule as proposed. Next slide, please. Now we'll think about what it is to offer services. That term offer services, and specifically services with respect to securities, does clarify some points that have been uncertain under the existing rule and staff guidance. So actually here, let's start with what is excluded. Communications from an advisor that talk about the advisor's culture, its philanthropic activities, its engagement with the community, would not be considered advertisements. So for example, if your manager posts on LinkedIn or posts on its website information about a tree planting event that you undertook at a local park, that's certainly not going to be an advertisement as long as you're not seeking new or generally seeking advisory clients. White papers and educational material will also not be considered advertisements as long as they don't have some sort of call to action or reference to your investment strategies or statements that would cause a reasonable person to believe that they were put together with the intent of causing people to believe that it's prudent to come and invest with you. So if you are a quant manager and you want to put together a white paper that describes why quantitative investing as a generic concept makes sense, why multifactorial models are prudent manners to select securities, that's not going to be an advertisement. On the other hand, if you put together the same paper and then you say, at my shop XYZ, we use these multifactorial models in the following manner for our strategy, and we think it works well, then that would transform what is otherwise educational material into an advertisement. Finally, brand content. Simply putting the name of your advisor out there is not going to be an advertisement subject to this rule. So for example, I recently had a client who wanted to sponsor a hockey league, a youth hockey league. And they asked me the question, is this an advertisement? And under the current rule, it was pretty uncertain, but under the new rule, sponsorships, statements that such and such a service is brought to you by the advisor, those things are not going to be advertisements subject to this rule. Now, by contrast, as I mentioned for the white papers and educational materials, if you have a communication that would otherwise be outside the scope of the definition, like brand content or a white paper, but then you supplement that communication with some commentary about why your advisory services are beneficial or may be beneficial to clients, then that changes it to a promotional communication, and then it would be within the scope of the rule. Now, finally, if we can go to the next page, we want to spend a little bit of time thinking about this term within the definition of a direct or indirect communication. And this is a very important term that has a fair bit of interpretive gloss provided in the adopting release from the commission. And it bears very much on third-party content, bears on social media, which we'll talk more about later. It bears on whether an advisor has an obligation to look at and to ensure compliance in communications that are disseminated by intermediaries. So first, let's talk about what is considered an advertisement. As it pertains to third-party content, you will have an advertisement for which you are responsible under the rule if you take some sort of affirmative step to involve yourself in the preparation or the presentation of the material. You can imagine how that's important for social media, because if you have third-party content on a social media site that you manage and you are involved in writing that content, or you are paying someone to write the content, you'll probably have an endorsement, but you would also have an advertisement under prong 1 here. If you have solicited someone to write that content, also if you sort the content, if you encourage people to focus on certain content, you're taking some sort of affirmative step that is going to cause you to be responsible for that content and cause it to be an advertisement. Any sort of selective highlighting, prioritizing, or deleting of material means that you become entangled with the content and it's your advertisement. Now, similarly, in the context of intermediaries, if you participate with an intermediary in the creation or the dissemination of material, it's going to be your advertisement. So for example, if you are working with a wrap sponsor, or if you are working with a placement agent, and that wrap sponsor or placement agent works alongside you to develop content, and you're involved in the creation of that content, it will be your advertisement, even if you are not the person sending it around. Likewise, if you send materials out to intermediaries and you have a reasonable expectation that they are going to distribute that content onto third parties, you will be responsible for the content. And it will be more and more important, I think, in coming years to mark these things as confidential and not for distribution with the public to protect yourself from that sort of responsibility. Now, on the other hand, this is also helpful because to the extent that there is third-party statements or third-party content or third-party communications that pertain to you as an advisor or even pertain to your services, if you didn't solicit those, if you didn't provide authorization to those third parties to disseminate it, if those third parties make modifications to the material that you didn't authorize, those won't be advertisements of yours. Similarly, in the social media context, if you don't make edits to commentary, or if you make edits solely based on balanced or objective criteria, like, for example, the removal of sexually explicit or otherwise inappropriate material from your website, you won't be included with those contents. Finally, and very importantly, there is updated guidance, and we'll get to it later, regarding the use by employees of personal social media and whether or not that personal social media would be imputed to you as an advertisement. I will flag in advance, in case we don't have time later, that the release, even though it's not written in the rule, the release really focuses on whether or not you as an advisor have put together reasonable policies and procedures designed to ensure that your employees don't use their personal sites as an avenue to communicate with the public about your services. And if you do that, there will be a presumption that you are not responsible for their communications. So Sanjay, we spent a lot of time talking about what an advertisement is. Should we shift to why that matters and what the specific prohibitions are under the rule?
Yeah, let's talk about some of the other provisions of the new rule. So on this slide, you see a list of what the SEC calls general prohibitions. This is in the very beginning of the new advertising rule, the first section that you'll see. And just a couple of three key points about this. In fact, there's actually four, but the three main ones are that all these general prohibitions apply to all advertisements. You are permitted to consider the facts and circumstances. So for example, the nature of the audience that comes into play. And really a lot of these, in fact, all of these should sound really familiar to you. These are, I would argue, and I think we would all argue, that principles that have been in play for a long time now. And to a large extent, you should hopefully be familiar with these concepts. So let's talk a little bit about each of these. So the first one is that an advertisement may not contain any sort of untrue statements or omissions of material facts. Again, this should sound familiar to you because it's essentially the anti-fraud provision of the Advisors Act. But according to the SEC and the adopting release, this new provision is designed to be specific to your marketing activity. So it's designed to sort of supplement what's already sort of the general anti-fraud obligations, which, as Mike noted, are always subject and are always in play regarding all your communications. The second bullet talks about unsubstantiated material statements of fact. Now, a couple of key points here. The first is the word unsubstantiated. This received a lot of comment, a lot of concern, and so we were happy to see that the SEC in the final outcome built in a reasonableness standard. So you have to have a reasonable basis that you can substantiate the information upon demand, essentially by SEC examiners. Now, the second major change from the proposal is that they went with a statement of fact versus any material claim or statement as proposed. This is a great change because I think makes it a lot easier for you to be able to substantiate a factual claim. So this is I think an improvement that really addresses a lot of the concerns that were raised by commenters. Now, the third bullet is any statement that's reasonably likely to cause an untrue or misleading implication or inference. Again, they added the reasonableness standard here. There's an interesting discussion in the release that I'll highlight here, which I think sort of explains what's going on here. The commission notes that, for example, in a situation where you have testimonials listed on a website, you're not required to sort of necessarily have an equal number of positive testimonials with negative testimonials. And so there is sort of this reasonableness standard built in here. The next bullet is the failure to provide a fair and balanced treatment of material risk or material limitations. I think the one thing I want to highlight here is, and then Mike will talk about later, is that there's some discussion in this section of the release about being able to hyperlink and use layered disclosures when you talk about fair and balanced treatment. Again, I think there are going to be a lot of interpretive issues on that, but being able to hyperlink to additional disclosures is something we had stressed in our comment letter, and to I think, I don't know, a great extent, Mike, or to some extent, the commission is moving in that direction, and I know you'll touch on that in a few minutes. I want to highlight this next one, and that's why it's written in red. It's the anti-cherry picking provision. So you're required to present in a fair and balanced manner any references to specific investment advice and presentation of performance results. Now, this is an area that, again, where we've been advocating for a long time. I think this is perhaps one of the top complaints that we hear about the current rule, which is you'd like to be able to tell stock stories. You'd like to be able to reference particular specific investments to tell a story of how your strategy is informed given any market conditions. Those are just some of the examples. And as you know, under the current framework, which again is developed through no action letters, it's really sort of limited you to what you can talk about. So we were pleased to see this become sort of a principles-based, fair and balanced disclosure-based approach. A couple of key points here. This will cover, the principle here will cover profitable, non-profitable, past, current recommendations. And the commission notes in the adopting release that the no action letters no longer have to be followed. It's going to be a facts and circumstances analysis. And the key point here is that you will be permitted to include the sophistication of the intended audience, the audience. So for example, if you are providing this information to institutional investors, that you would not have to provide as much disclosure as you would, say, if you were talking to retail-based investors. So, I think this is, again, another area that's a huge improvement over the current status. And so we were pleased to see that in here. The last bullet, otherwise materially misleading, I always thought that was sort of an oxymoron, but it's essentially a catch-all provision, and that's really what that is. So again, there's some guidance in the adopting release. We'll talk about these principles in future webinars, but again, these are essentially the principles that I think have been in play. There's some good discussion in the release that fleshes out some scenarios. So with that said, let me turn it over to Laura to start talking about some of the other specific elements of the final rule.
Great, next slide. So let's take a closer look at some key definitions in the rule. And I think it helps to compare the definitions of testimonial and endorsement side by side. A testimonial refers to a statement by your current client or your current private fund investor about your firm or about your supervised persons. In contrast, an endorsement refers to a statement about your firm or your supervised persons by someone who is not your current client or not your current private fund investor. So just remember, testimonial is current clients and investors. Endorsements is not current clients or investors. And if you're wondering what supervised persons mean, that's your officers, partners, directors, or employees, or anyone else who provides investment advice on your behalf and is subject to your supervision and control. And that's a definition in the Form ADV glossary. And then the definition of third-party rating is intended to permit advisors to use these third-party ratings subject to conditions that we will touch on when the ratings are conducted in the ordinary course of business. Next slide. Here's the definition of testimonial more in depth. Again, it's a statement by a current client or private fund investor about their experience with the advisor that solicits or refers someone. It could be a current, could be a prospect, could be a client, could be a private fund investor. Next slide. And here's the definition of endorsement again. This is a statement by someone who's not a current client or private fund investor. So the rule will permit an advertisement to include testimonials and endorsements, but they will be subject to some conditions. And those conditions involve certain required disclosures, advisor oversight and compliance. For example, the final rule will require an advisor to have a reasonable basis for believing that any testimonial or endorsement complies with the rule, and an advisor will have to have a written agreement with certain promoters. Also, in some cases, you'll have to consider disqualification of people who have been engaged in certain misconduct in the past 10 years. So those are the basic conditions. We'll go into them in much more detail on a future webinar in our series. Also be aware that there are partial exemptions from some of those conditions for different categories, including de minimis compensation. So if you're paying a promoter less than $1,000 in the previous 12 months, that's considered de minimis. And there's a lesser mix of conditions that you have to comply with. There are also partial exemptions when the promoter is an affiliated person, when it's a registered broker-dealer, or when it's a person who's covered by Rule 506D of Reg D if you're dealing with a securities offering. So stay tuned on another webinar. We'll go into depth on all of these issues. But for now, Sanjay, can you tell us more about third-party ratings on the next slide?
Okay, so yes, so the new rule permits third-party ratings. It's defined as a rating or ranking of an investment advisor provided by a person who is not a related person, and such person provides such ratings or rankings in the ordinary course of business. Next slide, Megan. So these are the conditions that you have to satisfy in order to meet the third-party ratings obligation. Obviously, you have to satisfy the general prohibitions that we talked about. The first is some level of due diligence. And here you have to have a reasonable basis for believing that any questionnaire or survey that's used is structured in such a way to give a participant an opportunity to provide favorable and unfavorable responses. And it's not obviously designed to prepare or produce any predetermined result. The key word here is reasonable basis. There was a lot of discussion in the comment letters, including by us, as to what exactly that means. Do you actually have to go out and get a lot of detail from the rating provider? Will you be able to do that? The Commission in the adopting release has statements to the effect that you will not be required to actually obtain complete information on how the data is collected or how the ratings are calculated. You are permitted to seek representations from the rating agency regarding, quote, general aspects of how the ratings are designed, structured, and administered. So there is a due diligence obligation. The second component you have to satisfy is the disclosure, as you see in these bullets, the date on which the rating was given, the period of time, the identity of the third party that created or tabulated the rating, and if applicable, that compensation has been provided directly or indirectly by the advisor when obtaining or using a third party rating. So these are the requirements that you would have to satisfy. Let me now turn it over to Mike to run us through the performance provisions of the new rule. Next slide, Megan.
Thanks, Sanjay. One of the questions that we received was, are there any areas that were considered a disappointment to the IAA? And I don't speak for the IAA, but speaking personally, I do think that there were some disappointing outcomes in the treatment of performance information in the final rule. Now, let's put this in context. Among the principles-based prohibitions was a prohibition on presenting performance, investment performance of any kind, unless it is presented in a fair and balanced manner. And these requirements are specific requirements that are layered on top of that general obligation. Consider them specific requirements that the Commission felt had to be met in all cases because they raise such incredible risks of misleading people. Let's run through what they are. First of all, in the proposed rule, there was a proposition, a suggestion that any presentation of gross performance would need to be accompanied by a schedule of fees, and that has been removed. You do not need to include your schedule of fees when you are presenting performance. Next, and this is a very big one, any presentation of gross performance must be accompanied by net performance with presented with equal prominence. In the proposal, and for that matter, under the current rules, it is permissible to present gross performance without net performance side by side under certain circumstances, specifically when that presentation is to a sophisticated party and presented in a one-on-one manner. That has gone away under the rule in all circumstances. You need to present net performance alongside gross performance with equal prominence. I say in all circumstances, I should clarify, unless it is provided in response to a specific request for gross performance by an investor. Now, in addition, under the rule as passed, there will be a requirement to present performance across 1 year, 5 year, and 10-year periods in all circumstances, regardless of the sophistication of the recipient. There is one exception, and that is for communications to prospective private fund investors. We understand that that exception was meant to address the fact that 1, 5, and 10-year presentation of performance is not really meaningful when you're presenting IRRs. Now, that said, there are also circumstances where IRRs should be presented to prospective advisory clients. And in those situations, you still need to present 1, 5, and 10-year performance, even though in my view, it might be misleading. You could present the 1 year, 5 year, and 10-year IRRs, as well as a more meaningful inception to date IRR, but net performance and 1, 5, and 10-year periods need to be included in substantially all communications, regardless of the sophistication of the recipient of the communication. Now, a couple other important points on performance advertising. Number one, there are now rule-based requirements, and for that matter, permissions around the calculation of net performance. To jump to the chase, net performance can be calculated using all of the constituent accounts' actual fees and expenses. It can be calculated based on a model fee, as long as that model fee is no lower than the performance that would have been produced if you would use actual fees. And now, in what's actually a relaxation of the current rules, model fees can be used to calculate net performance as long as the model fee is no lower than the highest fee charged to the type of recipient that you are communicating this to. So if you're an advisor with all different types of clients and you have different fees for large institutions that bring a $50 million mandate on the one hand, and for wrap account clients on the others, in a communication directed to the institution, assuming that that fee is lower, you can use those fees as your model fees, even though the wrap account clients may pay higher fees. Statements about commission approval of any performance calculation methodology are prohibited. And now there are also some requirements around related performance and extracted performance. I want to focus on related performance because extracted performance is a relatively rare situation where a firm extracts some trades out of a single portfolio, but not other trades. This would be, for example, if you have a balanced portfolio of stocks and bonds and you extract the stock performance. It does not relate to situations where you take all of your bond trades from all of your balanced portfolios. That's considered hypothetical performance information. But to related performance, one requirement under the rule as proposed was that anytime that related performance was shown, the advisor would need to show the performance of all of the related portfolios, unless excluding one or more portfolios would result in performance that was no better than the performance if they had shown all the portfolios. Well, if you think about this, that would have meant that the use of representative account performance was almost impossible, because usually there would be one time period for which the representative account would be better than the composite, or you might need to switch representative accounts depending on how a rep account did over the preceding quarter. There's been a good change here, and that has been adjusted to provide that you can use related performance and you can exclude certain accounts or use rep accounts as long as the performance is not materially better. than if you had used the entire composite. Jumping to hypothetical performance, recognizing we're a little bit pressed on time, the points that I want to make here are twofold. Number one, there are some very specific requirements. Requirement number one, you need to have policies and procedures reasonably designed to ensure that if you were showing hypothetical performance to a prospective investor, that it is meaningful and that the investor has the sophistication to understand the hypothetical performance. Requirement number, I should say, 1A, that was 1A. 1B is to include disclosures that reasonably describe how the hypothetical performance was calculated. What standards did you use? What data did you use? What methodology did you use? And requirement 1C is that you include cautionary disclosures about the risks of relying on hypothetical performance information. All of this is actually pretty similar to what at least buy-side counsel recommend and compliance consultants recommend to their clients that are using model or back-tested performance today. Now it's reflected in the rule. But here's a very important change from the way that we look at things now. As proposed and in the final rule, performance targets are considered by the SEC to be hypothetical performance information. And that means if you want to do something that seems to be fairly innocuous, like say, our strategy is intended to, or we aim to outperform the S&P 500 by 2%, or we take on risk that we expect would cause us to be within the returns of the S&P 500 by plus 3% or minus 3%. That is considered hypothetical performance information and subject to all of the requirements that I just listed in the same way that back-tested performance information would be. It might be that the disclosures for targets are shorter, but the policy requirement, the calculation requirement, and the cautionary disclosure requirement will apply to target performance. Finally, the positions of the SEC staff, the historic positions of the SEC staff regarding performance portability, which for those who aren't familiar with it, is the practice of presenting the performance of portfolio managers from their time at a prior employer after they've come to your employer, have been restated here in the rule. By and large, they match almost exactly the standards of the staff, although there will be a couple questions, particularly as they pertain to situations where a team moved over 10 years ago and that team has evolved organically over time, but the team is not exactly the same people who came over before. There is a question as to whether you will be able to continue to show that performance. Hopefully it will be addressed in FAQs. Next slide, please. So real quickly, what's the real impact of these changes for performance advertising? The way that we thought to approach it is to split it between what are the changes to your content and what are the changes to your policies and procedures. Running through it real quick, if you are an institutional manager, you are going to be including net performance side by side or otherwise equally prominent with your gross performance going forward, whether or not it's a one-on-one presentation. If you are a retail or a wealth management manager, the use of performance targets, simply stating what you aim to do, is now going to be a little bit more difficult and it's going to require a lot more disclosure. You may even choose not to show them anymore if you don't want to improve the policies and procedures and the disclosure requirements. If you are compliant with GIPS or you otherwise prepare composites and those composites have carve-outs within them, things get a little bit tricky here because composites with carve-outs are going to be considered hypothetical performance information and subject to those requirements that I listed. And finally, everyone everywhere, with the exception of private funds, will be showing 1, 5, and 10-year performance, whether or not your clients want it. Now, that's the change to the content of your presentations. We'll run quickly through the policies and procedures. If you have target performance model, back tested, or anything similar, you're now going to have an expanded policy and procedure library to address those activities. Number two, if you have rep accounts, or if you exclude certain accounts from composites, you're going to need to have a policy that reviews the materiality of any differences in performance between those rep accounts and your composites. You will probably change your process for calculating net performance In some situations, that's going to require changes to policies and procedures. And finally, we haven't talked about this a lot, but something that we did note is that there's now a currency requirement, which is to say the commission was concerned that performance was stale and the presentation of stale performance might not reflect newer developments in your performance history. I'm a little bit concerned because the way they reflected that performance needs to be current is that it needs to be no less recent than the most calendar year end. And if you want to send something out on January 4th, or for example, January 5th, I think it might be kind of challenging to advisors who have not yet calculated their December 31 performance. I am hoping that there will be some staff guidance on this issue, but watch out for that. Luckily, we don't need to worry about it this year. Next slide, please. So Laura, what are some other policies and procedures we need to worry about?
Well, even though the SEC dropped the proposed pre-approval requirement, you still need to come up with policies and procedures to prevent, detect, and correct violations of the rule. The Commission says in the adopting release that for compliance policies and procedures to be effective, they should include what they call objective and testable means that are reasonably designed to prevent violations of the rule. And they give the examples listed here of ways to establish those objective and testable compliance policies and procedures. Internal pre-review and approval is listed because even though it's not required, it could make sense for some firms. But if you don't want to do that, other effective methods could include reviewing a sample of advertisements based on risk or pre-approving templates. Effective methods to detect and correct violations and prevent future violations could include spot checking advertisements and conducting periodic reviews. And advisors should consider training on the new requirements and prohibitions of the rule for any employee involved in the creation, review, or dissemination of advertisements. So I think you can expect your policies and procedures to be an area of interest for the Division of Examinations, formerly known as OC. With that, Mike, I'll turn over to you to talk about social media. Next slide.
Hey, listen, Mike, we're obviously gonna go over here, but let's continue. I want to make sure we get through all the slides for everyone in the audience. A recording will be available afterwards. So if you have to jump, we understand. You can always come back and listen to the end. But I want to make sure we get some of these practical takeaways when we talk about social media. So let's run through these slides.
Okay. So although social media was not expressly addressed in the rule, there is guidance within the rule release, particularly around direct and indirect communications that really does tell us now, gives us a path forward for social media. The key points that we want to make here are, number one, there is now no per se ban on the presentation of testimonials. So you are a little bit less concerned about having a website and even redistributing testimonials that are given via social media. Now, you do have a large body of requirements that you need to comply with as to testimonials if you redistribute them, as Laura had mentioned, but that can be done. Number two, I'm going to jump down to the bottom here, actually. The staff gave guidance, as I indicated earlier, that, or not the staff, the commission gave guidance in the rule release, that they would not consider the postings of firm employees to necessarily be advertisements of the firm, provided that the firm exercised oversight and supervision, typically in the form of training and review, to ensure that employees understood the importance of not engaging in traditional advertising via their own personal pages. Now, this is the position that a lot of us have wanted to take, and that some managers have implicitly taken. It is very good to have the support of the guidance within the rule release to support that. Another important change for social media is language within the rule release that addresses hyperlinking and the concept of layered disclosure. Now, historically, the SEC staff has taken the position that for a disclosure to be meaningful and to be useful, it needs to be within the four corners of a communication. Obviously, that is very difficult to apply in the context of Twitter, sometimes in the context of LinkedIn and similar venues. However, now it seems that the commission's view is that you need to consider the importance of the disclosure. And within the rules, certain topics like testimonials and endorsements, in some cases, require prominent and clear disclosure. In those situations, it would need to be in the tweet. Other issues, like the presentation of performance, require fair and balanced disclosure. And there was guidance that said, as long as you have a balanced amount of disclosure, not necessarily all the disclosure that a person would need, but a balanced amount of disclosure with the information that requires a fair and balanced treatment, then you could hyperlink the additional disclosure to somewhere else. And implicitly, I think, even though it's not written in the rule and not written into the release, this suggests that disclosures along the lines of things that don't need to be clear and prominent, and that don't need to be presented in a fair and balanced manner under the rule can be hyperlinked. But if you're going to do that hyperlinking, I think that it's very important to consider you probably should draw some attention to the hyperlinks, and there may be situations where you need to have something be more prominent just to ensure it's not misleading. But all of these developments make social media easier to implement and a lot cleaner, but it's going to take some time parsing through the rule to implement them in the form of actual policies. Next slide, please.
So beginning with your annual updating amendment to Form ADV that you file after the 18-month transition period, so not this year, you'll have to provide information about your use in advertisements of performance results, specific investment advice, testimonials, endorsements, third-party ratings, hypothetical performance, and predecessor performance. Also, whether you pay cash or non-cash compensation for testimonials, endorsements, or third-party ratings. So the rule amends the instructions to Form ADV to incorporate these changes. Next slide. The SEC also is expanding the books and records rule, Rule 2042, to reflect the new marketing rule. Some highlights are listed here. It does expand the current rule, which requires advisors to retain only advertisements sent to 10 or more persons. You can store records using email archives, such as cloud storage or third-party vendors, provided that you can promptly produce those records. The advisor will no longer need to obtain a written acknowledgement from each referred client that they've received that require disclosure. And a solicitor, which is now called a promoter, will no longer need to deliver a copy of the advisor's brochure to the prospect. Sanjay?
Next slide, Megan, please. Okay, so let's talk about the transition period and wrap it up with some practical takeaways. So the commission adopted is providing an 18-month transition period. This will be between the effective date, which is going to be 60 days after it's published in the Federal Register, which has not happened yet. And so it'll be 18 months from that will be the compliance date. We were able to get confirmation from the SEC staff just this past week that for firms that want to begin complying anytime after the effective date, you are permitted to do that. So you don't have to wait to the compliance date. A couple of key points here. According to the staff, partial compliance is not permitted. You'll no longer be able to rely on SEC staff guidance that's going to be withdrawn, and your record keeping obligations will kick in. So you do have the option to start complying early, but you just need to be mindful of some of those key points. With respect to Form ADV, filings after the transition period are required to complete the amended form. You're only responsible for filing the amended form that includes the responses to the questions that Laura talked about in your next annual updating amendment that's filed after the transition period. And if you decide to comply early, as I just talked about, advisors will not be expected to do off-cycle Form ADV updates. You could provide the new required information at the next time updates are made to the form. This was guidance that we just got from the SEC staff. And so that's the transition period. So next slide, Megan. Let's provide you with some sort of practical takeaways. Again, there's an 18-month transition period. You're obviously going to need to start thinking about all these issues. So what we'd like to do is to maybe give you a list of things that maybe might be helpful to start thinking about sooner than later. Really, the first thing you have to do is decide what you want your compliance timeline to be. As I noted, you can start complying early if you want. You don't have to wait for the whole 18 months. Once you've decided what the timeline is going to be, you obviously can work back your implementation period. a couple of things here. You obviously want to consider your business side, their needs for marketing, but also if you're a compliance or legal professional, you want to make sure your bases are covered on that front as well. And in that regard, you want to start thinking about how you're going to train your business side, your marketing folks, your compliance colleagues on the new rule. We'll certainly at the IA be there to help you through that process, but you want to start thinking about a plan for that. And then you want to start assessing all your applicable policies and procedures related to marketing and solicitation to ensure that they will be in compliance with the new rule, as well as your record keeping obligations. Mike, what should folks be thinking about in terms of performance advertising?
Look, as we put on the slide that showed things that you need to worry about for content on the one hand and policies on the other, my suggestion here is get in front of your sales teams, because as soon as they hear that they can use stock stories and there's no longer a prohibition on past specific recommendations, they're going to say we want to come in here immediately and comply with the new rule. But you've got to educate them about the net performance changes, the hypothetical performance changes, and then run through the policies that we listed and ensure that as an organization, you have a plan for how you want to come out before you make any changes to the presentations that you actually use with clients.
And then on the solicitation side, you'll want to think about your current arrangements and think about how they'll need to be amended. Also, think about any indirect compensation or non-cash compensation that you provide now that those will be captured. Understand the regulatory status of promoters because they might have to register as an investment advisor, and consider the expansion of the rule to private funds, which leads to the last point. Mike?
Yeah, unfortunately, the rule release does have a passage that says that while the terms of an offering that are contained in a PPM would not be considered an advertisement, that promotional language within the PPM would be considered an advertisement. And it uses the example that any prior performance or related performance within the PPM would in most cases be an advertisement. So get prepared for your compliance departments to start getting involved in the drafting and review of your PPMs.
Next slide. Note that the slides of today's presentation were included in the reminder email that you received this morning. Also, to assist IA members through implementing the new rule, we have formed a marketing implementation group. If you were previously a member of our advertising working group, you have automatically been transferred over. If you are not and would like to join, please email iaa.legalteam@investmentadvisor.org. Also, we'll be developing a resource page on our website that is dedicated to implementing the new rule. You can always ask questions of the IAA community by posting on the IAA Exchange, which is our online discussion forum. We are forming a community that is dedicated to the marketing implementation group. And as we noted, this is just the beginning of our webinar series. We'll be taking deeper dives into specific aspects of the rule. Our next one will be January 21st at 1 o'clock Eastern time, and we'll be sending details on that. Next slide. Finally, the IAA's annual compliance conference will be held March 3rd to 5th. It's 100% virtual this year. We'll have a session dedicated to the marketing rule, and registration is now open on our website under events. Thank you so much to everyone for joining us today. This concludes our webinar.